Good morning, everyone, and welcome and thank you for joining us for today's Decipher with Dezerv session. We are excited to have this conversation with you. Along with me, I have Pratik. Pratik and I both manage strategies at Dezerv, right? Today's webinar, we are going to take things a little differently. Instead of running you guys through the same routine presentations and slides, we are going to have a dialogue. It's look at it this way that these are two colleagues who are having a discussion about markets and the topic what we have today, and you are getting a glimpse of this. Now, coming to the main point, right? Over the last few months, we've been constantly getting this question that is it the right time to invest in mid caps and small caps? Aren't they at all-time high? And the answer to this question is not a simple answer, right? It's not a yes or it's not a no, right? It's far more complicated than that. But what we thought is instead of just diving into the topic today, let's first take the lens out. Let's understand what is happening globally, right? And in global market, there are four major themes which are evolving. And in fact, these themes, or you can call it the four major issues, right? Now, this ranges from AI bubble, tariffs, de-dollarization, and sovereign debt. So our idea is that we'll decode this each one by one and take you through our views are and how India is positioned.
Yeah, so
So moving on to the first point, right? What we want to cover today is the de-dollarization, sovereign debt, and tariffs. Pratik, what are your views on this?
yeah, so actually, if you are to analyze the global backdrop, the entire problem stems from one thing, which is the rising debt for the developed world. So currently, as we speak, US GDP debt to GDP ratio stands at 125%, which is high by any standards, right? And for them also, it's new. It's the highest in their history. Because of this also, what we are seeing right now in US is that they are undergoing the longest ever shutdown of more than 35, 36 days. Flights are getting cancelled and stuff like that. But the again core underlying behind this is that their debt to GDP ratio is high. uh, Now when your debt to GDP ratio is high, the other two things that are coming out of this scenario is basically your country has to now, or US has to now impose tariffs on people who are supplying them goods. And second is that they have to print more dollars so as to be able to repay this debt. So money printing and tariffs are the you can say the side effects of having a high debt to GDP currently. In case of tariffs, it's just begun. There is some impact, but no major impact that we are seeing as of now. Uh, Also, some of the countries, US has arrived or reached a deal, but countries like India, Brazil, who are yet to crack a deal with trade deal with US, they are particularly seeing some stress. In terms of the where the pain is more evident is the money printing bit. So that happens in the form of uh, 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 gold prices or hard assets becoming dearer. Now, if you see 10 years back, for money supply in US, we look at this indicator called M2, right? 10 years back in 2015, whatever the M2 was, let's say there were $100 in the US, that has grown 1.8 times. So now there will be $180 because the country kept on printing. So the money supply has gone up 1.8 times. And what has happened to gold and silver? That has gone up 3.5 times. So basically you can say all the US money in 2015 would could have bought 10 billion ounces of gold, but now it can buy only 5 billion ounces of gold. So the value of dollar has depreciated. Now this was pending because you are going to print so much money. Obviously, your currency will depreciate, and hard assets like gold, silver, real estate, etc., appreciates. But this is a trade which has majorly taken place. There could be some bit. of adjustments left here and there, but majority of it, I believe, is in the price, and dollar has paid the price for America's fiscal imprudence and high debt. That's how I'm looking at these three things, which is your sovereign debt, the tariffs, and the money printing, Kumar.
So that's interesting. So actually, like in a nutshell, what you're saying that you spend more, you need to find more income, and tariff is the solution for that, what US has found today.
Yeah.
Now, so there is another and the last global major concern which everyone is talking about is the AI bubble. Now, my
Yeah.
view is a little different over here.
Hmm.
While AI is all out there, it's an early stage transformation stage, right?
Okay.
Today, AI is not something, it's just a concept. It's actually out there.
Hmm.
It's becoming more transformative. It is actually enabling productivity in the system.
Hmm.
But any transformation, whenever this happens, right, the
Yeah.
expectations are always higher than the near-term earnings. And this has led to some valuation stretch in some of the AI companies. So while we strongly
But
believe that yes, there will be some volatility because of that, but
hmm.
the long-term transformation, the long-term trend is not going anywhere. So AI and all the other companies which benefits from this are going to get eventually benefited from this AI. So it could be a volatile time, but the long-term story continues to stay intact in this segment.
Absolutely, absolutely agree with that, Kumar. But despite of all this noise, India's position is looking quite different, right? Can you want to walk us through some of the domestic indicators? How are you reading that?
Yeah, actually, like India's has stood out totally out from all of this. Just look at our GDP number. The
Yeah.
Q1 FY26 GDP came out at 7.8% year-on-year growth
Yeah.
rate. Now, this was third sequential quarter of higher growth rate, right? Now, this growth rate was majorly supported by services, which dominated, and also
Mm.
manufacturing.
Yeah.
So both these factors are very important. If you look at from the investment sides, right, the investment growth was also 7.8%, which means that there is a constant money which is going into growing, like building your infra, roads, networks, and everything.
Mm.
Now, your growth story is intact. Let's
Yeah.
look at inflation because growth inflation dynamics always matter.
Correct.
India's inflation, I think we touched almost 1% in the month of June. Roughly, we are at 1.5% as of September.
In fact, yesterday the indicator that came in was at 0.48%, if I'm not wrong, CPI.
Exactly. So your inflation is way within the RBI's range of 4% plus minus 2, right? You're
Mm.
very much in a comfortable situation. So
Yeah.
you have a strong growth, you have like a very steady inflation, which is
Mm.
actually leading to a lot of domestic optimism in the market, which you can see in the SIP inflows, right? So the SIP tsunami, which everyone is talking about, it's like monthly 29,000 to 30,000 crore of money is getting invested in equity markets. And
Correct.
that's huge, right? Now, again, against all this backdrop, right, you have all the global concerns, you have a steady macroeconomic, you have good inflows. The
Mm.
question still remains, right? Whether mid and small caps, where do they stand? Are they worth investing or there's a lot of concerns around that? Now, before we get into that, let's look at data, right? And because data speaks the truth. Last 1 year, if you look at small cap valuations, they have actually cooled down from 32.6 to 28.8. So yeah, there have been some cool off. Look at mid caps. Mid caps have cooled from 43 to 33 roughly. Now, one may say that okay, this correction could have happened because prices have moved down. But if you look at the P ratio, the price in both the segment, like mid cap index and small cap index, they've been actually near flat. So P has not moved, right? But the P ratio has come down, which means that earning has caught up
Thank you.
bit.
Yeah.
Okay? And that is the major thing, like what we call in market, this is not a price correction, it's a time correction in the market. So over time, as the earnings caught up, the valuations have cooled down. Now, let's look at the second more important thing, right? Q2 FY26 earnings, which are already coming up. So we analyze all the companies which have declared earnings from the with a market cap of 5,000 crore to 1 lakh crore, a major segment in mid and small cap space, right? The average sales growth has been 11%, and the average earning growth has been upwards of 12%.
Which
Now,
is decent.
more interesting here is the percentage of companies that have delivered more than 10% earning growth. That's 55%, right? Now, which basically tells you that this earning growth is not like a polarized or it's coming from select stocks, but it's much more broad based. And at this point, I wanted to add another data point, which Pratik recently analyzed. You want to take us through that ratio, what you were talking about, the gold to equity ratio?
Yeah, sure. So usually we do this valuation in terms of PE/PB. But one more way to look at this could be that how many grams of gold are we paying to buy a particular stock or an index? So we did this analysis on Nifty Midcap 150 index, and we found that on an average, let's say if we take the last 10 years data, we would have to pay 2.1 grams to buy 1 unit of Nifty Midcap 150, right? Now, but if you were to buy it today, you can buy it for 1.8 grams. So it is lower than the average. You have to spend less gold to buy Nifty Midcap 150. Similarly, for Nifty Small Cap 250 also, historically the average amount of gold required to purchase that index is 1.8 grams. But now that costs only 1.4 grams. So both of them are cheaper relative to gold as well, in case we are looking at it that way.
Oh, wow, that's interesting. I actually like the way how you done the analysis of M2 supply in the US market to buy gold and now looking at mid and small cap indices to buy gold and making a connection with the hard asset,
Yeah.
right? Well, that's interesting. Now, okay, we are here at this stage. Let's see what going forward, what are the major triggers in the market, right? And while we were looking at a lot of data, the most obvious one, like your GST rationalization, your 8-pay commission, they are all going to kick in and are going to support a lot of earnings from Q3 FY16 onwards.
Yeah.
So that is going to be a major booster in earnings for the companies. And we were just looking at some of this data like vehicle sales, credit card transactions. They are all like growing very strongly. So
Yeah.
from all of this, Pratik, you address some of the investors' concerns of growth drivers. But what do you think about sustainability over here?
Uh, So yeah, we saw in Diwali, just want to touch upon that again, right? Vehicle sales, just zooming through. Um, uh, Also, the interest rates that RBI has cut, they have brought down the interest rates from 6.5 to 5.5% now, repo. Uh, all the people who are paying their home loan EMIs, etc., will have some more room to spend, and the consumption engine becomes very strong now. Um, and rightly so, because you need a place to offset the impact that we might see, or we are starting to see in the exports place. Um, Second thing we've already talked about is the government, or in fact, we've not touched upon is the government capex, right? So that is a little bit overlooked factor in the growth right now, because we've talked about it in the last 1 or 2 years. Right now, we are not talking much about government capex. So when you see the GST rationalization, most people were expecting that it will cause a dent to the fiscal deficit, but that is not happening. And in fact, the GST collections, the last reported, they just went up. That's good news for fiscal deficit and government capex, and hence GDP, because if we manage to stay afloat and not the GST collection doesn't go down, government will have more uh, leeway to continue with its capex plans. Um, if your consumer is supporting the government capex is there, automatically the private capex has to get into the picture, and we are seeing some green shoots for that. The only risk that I feel right now is that in the interim, while we have a trade deal, you should not have surprises on the crude oil front. So as long as it stays, let's say, below $75, we should be good.
True. Now, all of this, like, let's do this rapid Q&A over here.
Okay.
Okay. Uh,
Okay.
we know the concerns in the market. I'll raise the concern. And what are our views? So let's say trade tariff impact. What's your view on that?
In the short term, we might see some sort of impact, but over the long term, what will eventually happen is we will find new trading partners, or we will, if the most likely case is that eventually India will strike a trade deal with the US. It could be X%, but it should not be as unfair as what we are looking at it today. So us at 50%, rest of them at 14, 15, 20%. What's your take on AI disruption, Kumar?
So I think India is very well positioned. We have a lot of youth, a lot of tech-savvy population. Uh, while AI as a technology has been evolved,
Hmm,
the application of AI is something where India will take a big way. And I think India will be a huge beneficiary in this segment.
hmm.
Uh, in terms of IPO supply concerns, what are your thoughts?
Yeah, so a lot of people are making out this to be a big issue, that there is a lot of supply of paper in form of IPO, QIP, rights issues, etc. So if we look at just IPOs, we have seen 2.2 lakh crores or 2.2 trillion rupees of IPO over the last 5 years. And in if we put the rights and QIPs also, that number will be close to 9 lakh crores. That is the supply side of it. But what we ignore is the demand side of it. So demand is much higher than that. Cumulatively, in just the DII flows, we have seen to the tune of 16 lakh crores, right? So that is double compared to whatever supply of paper that has come in terms of fresh issuances.
And actually, not to forget the oversubscription we see over here. Like some of the IPOs
Absolutely.
get subscribed 200 times. So the
Yeah.
amount of liquidity which is sitting on the side is
Yeah.
huge.
Correct. In fact, we have also managed to, uh, so this IPO supply that we have funded, we have done it at a time when FIIs were selling. Just
Yeah.
imagine the time when FIIs are buying, DIIs are buying, and then IPOs, it should not be a concern at all. Even as of now, it's not much. In fact, the the just for the mutual funds, the monthly run rate is around 29,000 crores of inflows every month, right? That is large enough to absorb, let's say, IPOs like three IPOs like Lenskart or one IPO like Hyundai every month.
Actually, true. That's a huge inflow coming in.
Yeah.
Right?
What's
So
our, if other than the IPO, if you can just summarize the growth drivers, we've already chatted about it, but for the audience, let's just summarize the growth drivers for
so
GDP.
for India, like it's always been a consumption market, and like half our GDP comes from that. But with GST rationalization and oh, with GST rationalization and the 8 pay commission which is coming in,
Yeah.
I think the consumption play is going to be at very strong. Like,
You want to tell us a little bit more about the eighth pay commission, Kumar, since you've
yeah,
mentioned it?
actually, so we were doing this data. With this 8 pay commission, there is an expectation that the salary hikes will be in the range of 30 to 35%.
Okay.
Now, this is a population of almost 1.1 million. So, yeah, almost like a 1 crore kind of a population, sorry. Now, imagine this kind of a population, you give 35% hike. This money is not going to be sitting into their bank account. There'll be an amplifying impact, right? They will go out, buy new houses, buy new cars, and do a lot of discretionary spend. Now, that has a multiplying effect in the economy impact. So the major growth driver which will come from this 8 pay commission, we are actually not able to even understand this as of now.
How big will this be in terms of the size of it? And
So we did this small analysis, like in terms of a fiscal deficit, let's say, because the government has to pay,
Hmm.
that is estimated to roughly 2 to 3 lakh crore. So
Wow.
that's the huge size over here, right?
Wow. It's almost two, three times of the GST impact that we are seeing.
Exactly. So, and the GST impact, right? So
Yeah.
with the GST reductions, everyone were waiting for the prices to come down and take the benefit of that. And
Hmm.
we'll see this in this quarter numbers.
Hmm.
So I think India's growth drivers are very much intact.
Yeah.
And the last point, like, there all you while you mentioned government capex, right?
Hmm.
And everyone's concern was when was the private capex coming in? I
Hmm.
think we are at the point where private capex is starting to build in now. and we will start seeing more and more as the consumption starts picking up
Yeah.
because your capacity utilizations will start coming up.
Hmm. Right. But what are the risks that you see for the growth or the economy
The
in
India's economy has majorly, India has always imported oil. So oil price being stable has actually benefited a lot of things for us, like from current account deficits
even
right
the
to our
inflation?
GDP growth.
Hmm.
Now, if we see any concerns happening in Middle East or oil prices spiking up, it
Hmm.
could be a risk for Indian markets. But
Hmm.
other than that, currently at the oil price of $65 per barrel, we are at a much steady place and much stable place. Like, and while in the past, when the oil price did spike, we were importing from Russia. Now,
Hmm.
with that, with more and more diversification coming in and the global pressure, I think that could be a major risk. Like if oil prices goes above $90 or something.
Okay. And now that we've spoken about the global macros, the Indian macros, the valuation in mid and small caps, can you just throw some light on how you are thinking that an investor should position themselves?
So let's take it a whatever we discussed. We clearly feel that there is a growth which is going to come in. Mid and small cap valuations have actually cooled down. So from here on, this space definitely has a long-term wealth creation potential, right? But
But are
it's
you
not
saying
going
you
to be
should go all in or?
yeah, so like that's the tricky part, right? If you go all in, it's going to be a very risky thing because you're still not at the below long-term averages valuations, you are still above them.
Hmm.
So it's going to be more gradual, more disciplined approach. So it's not like you just stay totally out of the market in this segment, but you slowly start gradually building your positions in this. So you
Okay.
have to be very selective. You have to be conscious about the quality. You have to be conscious about the companies which are delivering earnings consistently. And it
Hmm.
has to be measured allocation. Like you can't have a portfolio with only mid and small cap. Like it has to complement your large cap today and slowly build this portfolio because you cannot time the peak, you cannot time the bottom as well. Right?
Right.
And Pratik, any final thoughts on the mindset investors need to think about right now?
So I'll just share one small bit of research that I was doing day before. I went to the YouTube channel of one of the very famous YouTubers. Is a popular influencer, whatever we call that. And I looked at the past 30 videos and the views, counted the views on that and the title of the video. So wherever the title was sort of pessimistic, right? We had things like words like bubble, crash, overvalued, conflict, uh, failing. So the if when the videos with these kind of titles had three times more views compared to videos like LIC's Jeevan Bima Sugam and more informational videos, or even some of the interesting topics like the comeback of BlackBerry. Uh, so I think Morgan Housel he puts it very nicely. He said that pessimism it just sounds smarter and more plausible than optimism. So if you tell anybody that everything will be great, and they'll be like, okay, they'll shrug it. But the moment you tell them that they are in danger, you have their full attention. So yeah, pessimistic narratives are getting more click. You have people doing doomsday scrolling on the social media. But as a matter of fact, we should try to avoid that and uh, go for a more balanced and moderate approach while thinking of equity investments, especially in small and mid caps. Uh, that's my two bit on this thing, Kumar.
That's amazing. Like that's quite insightful. Sensation always sells faster, right? And that's what the news channels have always been doing.
Yeah.
Uh, Just to sum up our entire conversation over here, like the question, are mid and small cap expensive? The answer is purely, it depends. right? Mid caps valuations have actually corrected significantly from its peak, while small caps still carry the premium. Yeah. And the answer to this question is not a yes or not a no. The answer is about being selective, being patient, being disciplined, and you keep focusing on fundamentals and be data driven.
Mm.
So that's the sum up of all what we had to cover. Um, the Q&A session is open. Like, feel free to write your questions. We'll answer them one by one. So we have a question on the AI bubble burst, right? The question is approximately when the impact on Indian stock market, the impact on the IT sector, and should we keep money reserved to cash in this opportunity? I'll take this question. So, see, the AI bubble burst, in fact, like for last few days, we're seeing a lot of volatility in the market already. Now, let's look at a dot-com kind of a bubble, right? Where there was a major correction in the market because there was no output over there. Like there was no technology out there. There was only like, okay, there could be a technology which could be built. But this time around, there is an output. There is a technology out there which is more transformational in nature. So while people may be worried about AI bubble and link it to dot-com bubble, we don't see a similar kind of an impact where markets correct 40-50%. That's not going to happen this time around. So this time the technology is there, the productivity, it's a major productivity enabler, right? So impact on Indian stock market will definitely be there because while there is concerns globally and there is a volatility in US market, we cannot stay insulated. But will we correct and have a major correction like 40%, 30%? The answer is no. Maybe 5%, yes. But do we keep money reserved in cash for this opportunity? It's like as good as saying that 5% correction. So if you're investing in equity, right, 5% correction is nothing, right? It's the part of volatility. So there is no point sitting on the cash while deploying money. Yes, you could like if you're deploying any fresh capital, you could basically, instead of doing it all lump sum day one, you could basically tranche it over next 3-4 months.
Yeah, I also want to take an attempt at answering this one, Kumar. So when you ask AI bubble burst, approximately by when, there are two things you are concluding that one, there is an AI bubble, and then that it is going to burst. So what Kumar was trying to say that it, do not jump on that conclusion. Maybe there is no bubble at all. It's a fundamentally or uh, productivity driven technology that will actually generate money. Yes, there could be excesses in some part of the market, just like what we saw in 2000, that there was clearly an internet boom, but 20 years down the line, we cannot imagine our life without internet. And some of those companies did survive, like Google and Amazon. But sitting in 2025, it's very difficult to understand what AI will do to Indian companies, to the consumer, etc. in by 2045. So instead of speculating, the way to play this thing would be to uh, build your positions and adapt to it as the developments happen, right? So it's possible that the developments could be some of the developments could be clear. For example, power generation and energy storage, clean energy. Those are or even semiconductors where there is still value left. Those are some of the areas where AI can create a long-term benefit. So that is one. Impact on IT sector is anybody's guess, but in all probability, if you were just to asking a poll, my opinion would go towards that it would be uh, a enabler for even Indian IT industries because even something like Y2K, which could have been a simple problem, could have been easily handled by the US firms. They needed people to uh, uh, transfer that data, code those. So you need manpower to handhold uh, AI, at least towards the start of it, is what is it looking like. So wait for it, let it unfold, and uh, try to take one step at a time rather than creating a blur. view of the future and betting on it in a large way. Yeah. So the second question is how many small cap and mid cap funds you have in your PMS? Kumar, you want to take that?
Yeah. So currently we have two mid-cap funds in our portfolio. We have zero allocation to small cap funds. Uh, while we have zero allocation to small cap funds, the underlying funds, whichever we have, has some allocation to small cap, and that ranges our small cap allocation in the range of 8 to 9%.
Hmm.
Now, coming to the churn we have in our mutual fund, in our portfolio, our maximum churn in our portfolio is 25% in a year. While we have mentioned 25%, our actual churn ranges in 17 to 18%, right? Uh, Now, your last question, like your monthly data on different mutual fund varies drastically. Like sometimes it's a sell, sometimes it's a hold, sometimes it's like review. It's a possibility, but that would majorly happen when funds are more on the edge. So let's say if we have between like if we divide, if there are 40 funds in a large cap category, for example, and we've said that quarter one and quarter two are hold, but quarter three and four, like quarter three is review and quarter four is sell. Now, if a fund which is falling at the cusp of this, then this transition would happen, not otherwise.
What's your churn you have in these mutual funds? What is the churn you have in these mutual funds?
Yeah, so in this mutual funds, so the mostly these funds don't have such a high churn. They range from 30 to 40%, the underlying funds.
Yeah,
But
for us it is much lower. Yeah.
yeah, for us, it's much lower. While they have 40% churn, it does not bother us because one, given the MF trust structure, there is no impact of cost except for the brokerage or anything. Otherwise, there is no impact in terms of capital gain taxes. So that allows the fund manager to be flexible and churn their portfolios.
Understood. Okay, so okay.
We
We
have an
talked
interesting.
about PE data, price correction, etc. in mid. Actually, there's one more question by the same gentleman. Let's take that. Your monthly data on different mutual funds varies drastically from red to green,
No,
and
no,
again
that I've
red.
covered.
Okay, okay, got it. If
The-
dollar falls down to 65 rupees by March 2026, may happen by Jan 15th itself. What are the profound impacts? What is the strategy of Dezerv if dollar falls further in the next 3 years to rupees 10? What will Dezerv do? Wow, awesome. Uh, shall I go for that?
Yes, please.
So why should dollar fall to 65? Right? It's always a demand and supply question. So there are, let's say, $10 printed in the world, and there are 100 rupees printed in the world. If they are transacted for enough period of time, a long period of time, what will happen is $1 will eventually end up being equal to 10 rupees. Now, the demand supply economics will depend on how fast the rupee is being printed and how fast the dollar is being printed. Even today, after the US has printed so much of dollars, you can be rest assured that India is printing rupee much faster than what US is printing dollars. So that scenario where rupee goes to 65 and then to 10 versus the dollar, that is sort of a very far-fetched call as of now. Uh, yeah.
Interesting.
Second one
So,
is you, Kumar. I think this one is for you. You talked about PE data, price correction, etc. in mid small, but please highlight why small mid will do better going further with data, please.
okay.
What
So
are the compelling reasons to invest with current valuations of small and mid?
So the answer is that at the like and likely we mentioned, it's not a yes or no answer. The current levels are not the best entry point from a mid and small cap perspective, but they are also very important to start building your portfolio in mid and small cap space. So you need to be more disciplined over here.
Yeah.
Now, in terms of data, like what are going to be our major triggers? We covered that your 8 pay commission, your GST reduction. With this GST reduction, the underlying companies will have actually major boost in their earnings. Right? That's your bottom line. And your 8 pay commission will actually boost a lot of sales. That's your top line. So you have both benefits out there. So you will have a growth in top line and your growth in bottom line. Right? And that is why we are like asking investors to slowly build. Now, when we say we are slowly building, what we are also trying to tell you that the allocation to mid and small cap should complement your large cap, which means that your mid and small cap should not be more than 40% of your portfolio. Like 60 to 65% of your allocation should be large cap, and the rest 35% should be mid caps and small caps. That is what we are trying to address for you.
Do you see do you see in market consumption effect after income tax benefit till 12 lakhs per year income in last budget? So basically, I think it's asking for the exemption that the government gave up till 12 lakhs, you don't have to pay any income tax. Are we seeing any effect of that in consumption?
Actually, the answer is yes, because if you look at last year, last 1 year itself, right? The price has not moved and the earnings of the underlying companies have come up and they've caught up. That is also one of the drivers, right? Where people have more disposable income and they're spending more. While the impact is not that big because uh, the number of taxpayers in India is very low, right? So the impact is not such a big, but yes, we are seeing some early signs.
Yeah, GST touches a lot more people because anybody who consumes anything, it reaches them.
Yeah. So that's a broader universe over there compared to the income tax bit.
Fair. Next one is on the pay commission. I think 35% salary hike over what period?
Oh, so this is interesting. So the eight commission discussion starts. It basically comes after every 10 years. So the last sixth pay commission was in 2006, 7, six actually. Then
Mhm.
in 2016, where we had seventh pay commission, and right now we have this eighth pay commission, gets implemented by somewhere in June. This 30%, 35% salary hike is immediate, and the money they get it in arrears from Jan onwards. So that is what it is. So it starts immediately. It's not over what period. Like you have a 100 rupee salary from next month onwards, your salary becomes like 135. So for an entire year, obviously.
Uh, for quarter 3, quarter 4, 2025 and 26, what is the expected return minimum for equity category of mid and small cap? I'll take this one. So we will not be in a position to give you the expected returns. We're not supposed to do that. One is because of regulations. Second is because we don't know. Uh, uh, what what we can highlight is as Kumar showed in during the call. That the earnings growth and sales growth are in the range of 11 to 12%, right? If it and generally your share prices track the earnings growth and sales growth. Will it stay the same? Will it increase going forward? Will it reduce? Those are the questions or the uncertainties that we have to deal with.
Um, So Pratik, I think we have a lot of questions. I think we'll have to go a little faster here.
Sure.
Uh, like some of these questions which are repeating, we could skip out there,
Yeah.
right? So there's this question again on AI valuation crash or market US market crash will wipe out all of this. So the question is, should one wait, reserve the money, and invest in small mid when this crash happens? Any thought on this? I think we've addressed that query that AI crash it's already assumed that it's going to be a crash, right? While our belief is totally different, that it's not going to be a crash and it's going to be some correction, yes, but not a crash, what we've seen like a dot com. And again, investing in mid and small cap, continue to stay disciplined. Right? What's your outlook on starting a SIP in alpha focus strategy? This is exactly we've been shouting out loudly and telling you
Mm.
to like go discipline in the mid and small cap space. The alpha focus strategy for benefit of all our prospects and new guys who've joined in. It's a mid and small cap strategy what we manage. Here we only invest in mid caps and small cap funds.
Okay. What should be the optimal allocation to mid and small cap funds in current scenario for long-term wealth creation?
I think we've already covered 60 to 65 large cap as of now and 35% to mid and small cap. As the scenario evolves, as the valuation gets more comfortable or like earnings catch up, slightly increase by more 5% in mid and
Right.
small cap space.
Those who want to, in fact, take a higher exposure towards small and mid caps, I would suggest that they should also consider having some allocation towards gold, let's say 5 to 10% of their portfolio, just to act as a hedge, or because you are taking a riskier bet on the other side. But that's for, yeah.
Okay. I think we again have a question on SIPs in mid and small cap segment with a reasonable 10% allocation. The answer is yes, because we are totally forgetting the benefit of SIP here.
Mhm.
SIP itself means that it's a rupee cost averaging. Like you stay invested through the lows, you stay invested through the highs, be disciplined and accumulate more and more units over there. So there is no reason for us to stop our SIPs in any of this segment.
Okay, what's the next one? I can't score. What's the next one, Kumar?
Okay, we've covered allocation between large, mid, small.
Please avoid writing or calling out any particular fund managers or AMCs. Would want to avoid doing that. Yeah.
Uh,
Right. Yeah, this one, if you want to compare to .com and GFC, aren't we more certain of anticipating the bubble?
I think we've already covered that, right? So .com happened because the technology was not ready. GFC happened because there was a huge bubble in the housing segment where it was not backed by real money, right? And everything was on the loan, and the debt was a major problem over there if you think about it, right?
Yeah, so on the fundamental side, yes, the demand, or let's say the technology companies were exorbitantly overvalued in the US as well as in India. As long as you had technology in your name, and those companies were super very highly valued and formed a large part of the market. Even everything else was rallying along with that. So in terms of valuation, 2000. We are not at those levels clearly. As Kumar said, that we are closer to average. During GFC and .com bubble, both, most of the valuation metrics you were at all-time high. And that is not the case today, is what we are trying to convey.
This is an interesting question. Like with China's dominance in world market, how is India's performance forecasted in terms of manufacturing, mainly in chemicals and
Mhm.
other sectors? Also, with US prioritizing their own talent, will it affect the Indian IT industry? And how do you see mid-cap sectors for the next 2, 3 years? Pratik, you want to take this or you want me to?
Yeah, yeah, go ahead.
So while China has been the manufacturer of the world, it's a known fact, right? Increasingly, US and a lot of other Western countries do see that the risk over here because China's dominance is becoming far more stronger. And that is why we had that first trade tariff war, the trade war which we had between 2017, started with 2017. And some of the China's exports like were taken away and were going to the other emerging economies. So the world is also aware of it and they don't want to monopolize China at all. Right. Now, US is prioritizing their own talent because, again, like what Pratik was mentioning, because of the huge debt and everything. But when they prioritize things internally, like first we need to understand why did the jobs come to India? The jobs came to India because there was a major cost advantage. Now, is that cost advantage going away for the US or the US companies? The answer is no. Because the talent, when they hire in the US, the cost is far more than when they basically outsource it to India. Yes, there will be impact. There is no doubt on that. But the way we amplify thinking that, all the jobs are going to go away, all the IT firms are going to go to zero, it's not going to happen that way because it's not sustainable for even them. And while we do export services to US in terms of IT sector, there are also, we have enough amount of exports which goes to the European markets as well. So it's not like a doomsday kind of a scenario at all.
Yeah, so even let's address this one, whether exports is a crippler for Indian economy. And that is not the case, right? Definitely, any kind of impact there will have some bearing on our GDP growth rate and our GDP. But the major drivers for Indian economy, the biggest is the consumption, right? The domestic consumption, the people who consume various goods and services in India, we can manufacture for them, even if US is not buying. You have government capex, so government keep on building roads and other infrastructure in India. Uh, Again, no exports required there. And you have your private capex. So basically, companies expanding their businesses in whatever form and format. So these three engines of growth are still available with India. Trade, yes, there is an issue. In the long term, it could get sorted whenever we reach a deal or we find new trading partners. For example, we already did a deal with the UK, a trade deal with the UK, which was not there before the Trump tariffs. So as those are the two solutions for overcoming the export issue as well. And as we highlighted earlier, that yeah, during that period, the major risk will be the oil prices. If that goes bad, then it will be difficult to handle deficit. But Kumar, if you have offhand, what is the contribution of exports relative to other peers, and or maybe even the trade deficit?
So I would say that India's trade deficit today is 0.6% of the GDP. Now, there's another variable what we look at is the total trade. Now, the total trade of India stands at 45% to GDP. Now, this ratio is far lower compared to a lot of other emerging economies which are totally reliable, which are totally relying on trades. So that way we have enough cushion from an external point of view. Now, uh, let's look at from this trade perspective, how much do we export to the US, right?
Hmm.
So our total exports to the US comes to roughly 20%. Can we find alternatives over here? I think our government is constantly doing that how much of that 20% can even go further down. So the risk majorly is actually coming off from that part.
Got it. This is a classic. I'm sure many people will have these questions that geopolitical tensions, possible war, whatever global problems you can think of. Is it better to just invest in gold than shares? On this, I already touched upon the fact that, today you need less of gold to buy more of equity, right? In mid caps, it's almost historically you would have required 2.1 grams of gold to buy mid cap Nifty 150 index, but today you need lesser than that, around 1.8 grams. So that's the call. As of, yes, there was a trade in gold some time back, let's say around 75, 78,000. But it has priced in a lot of positives. And secondly, but that does not mean we are saying that we should not build a position in gold. It should be a balance between gold and shares. Gold should be between 5 to 10% of your portfolio, and the equity portion should be as per your risk appetite. Higher the risk appetite, higher allocation towards equity.
So we have this very interesting question, and I think we should have actually covered this point some time back. So the question says that in the long term, if the real growth rate in India is going to be 6%
Hmm.
and inflation coming below 4%, which means that your nominal GDP will grow in the range of 10 to 12% in the long run. So obviously, yes, the answer is the nominal GDP will grow at the rate of 10 to 12% in the long term, which also means that the, the GDP growth in India, which is equal to the earning growth in the equity market over the long term. So the point is that over the long term, our expectations from equity markets have to come off. Historically, our long term, like if you look at returns, the market from 1979 till date would have given a CAGR of 14.5% kind of a CAGR. Can we sustain that returns? The answer is clearly no way. But the point is that we need to reset our expectations of returns from the market and tone it down a little.
Yeah. This one is something that I think I have seen in every session. Uh, Kumar, let's hear your views on it this time. Is it a good time to have some exposure to cryptos like Bitcoin, especially given the uncertainties in the market and AI, and more regulatory support from US and other countries?
So I think this whole cryptocurrency things keep coming up at every crash. Like I remember 2017, 16, 17, 18, when the markets were like volatile, crypto came up. Then for years it went silent. Then again, when market saw volatility, it starts again picking up. But the point is, do we have the expertise to understand this and take those bets, right? The answer is clearly no. A lot of this is actually becoming more of a trading, and people are making speculative bets over here. Uh, in terms of like our view, the our government does not support. Your returns are taxed at the highest bracket. There is no motivation for us to generate return over here then. Like, your government is not supporting, you have no zero understanding of this segment. So we would actually shy away from investing in any crypto kind of an exposure. And the volatility is insane. Like it's more than the equity market volatility. Like we've seen things go up and go down like overnight.
Also, what you've seen in the recent past, Kumar, isn't gold a better hedge? Because crypto and gold serve the same purpose, right? Against the depreciation of currency. Aren't aren't commodities like gold and silver proving out to be better than cryptos for now?
Far more superior. Obviously, like it all depends from a starting point. Now, someone can go back and say, oh, in 2007, 8, when Bitcoin was launched, and I would have invested so much. Now it's a different ball. Like there was nothing. It was just emerging at that point in time,
Yeah.
right? And no one knew about it. So there's no point discussing that at that point in time someone would have invested. But gold has been here for centuries, right? It's not getting wiped out. There was one interesting data what we saw recently, that gold is becoming more of a reserve currency. Like the global banks, like the central banks across the globe, are using gold as a major source of reserves. So, like earlier, a lot of people used to buy US dollars because it was assumed to be a safe haven. But now, increasingly, more and more central banks are buying gold. So, obviously, like if you look at from a demand supply dynamic, we have a limited supply of gold. It's not an infinite supply of gold, right? So, that is one. The demand is very strong. Central bank across the globe are buying it. So you will be more safer buying gold as a hedge compared to Bitcoins and all those things.
There's one very pertinent question. If your PMS doesn't have small cap mutual fund currently, are you planning to include it in the short term? As you are advocating that slowly one should start positioning. So my take on this is that while we don't have small cap funds directly, we are taking exposure to mid cap funds and building our small cap position from that. Any thoughts on that one, Kumar?
Uh, so while we've been watching out the space of small cap very closely. Right now, we have not invested in a small cap fund, but as some the valuations a little bit cool down further, we will definitely add over there. At the same time, like in our alpha focus strategy, which is a purely mid and small cap, to align with this view, we used to first manage 60% small cap, 40% mid cap. We have switched the toggle and we moved to 60% mid cap and 40% small cap. So we've taken all those steps. As we see like more and more earning catch up, right? We've seen like a lot of earning getting catch up in the mid cap space. As we see the earning catch up happening in the small cap space and valuations cooling off further, we will start definitely adding small caps in the portfolio.
Got it. But any kind of forward-looking statement, we would just like to shy away from that. We are not certain how the markets will turn up going forward. But in the current scenario, yeah, as we said that it looks like credible. We want to wait it out till the earnings cycle is also over and we see more results on small cap, and then take a call. Uh,
And
till
like we
that time,
mentioned
we will.
earlier, right? Small caps, we want to be very selective.
Yeah,
Focus on quality, focus on consistency. So like slowly build out rather than like jumping in.
got it. Done. Do you want to take more questions or shall we call it a day?
I
There,
think we have
I
just a
don't think
minute,
we'll be able
so
to finish all of these.
yeah, there are 66 questions. I don't think so we can cover this. Uh, In the
What?
benefit,
Yeah. Yeah, yeah, please go ahead.
so given the time constraint what we have, we would recommend that you reach out to your RMs with your queries, and they can basically ask these questions to us, and we will answer back. I think that should be that way we'll be able to answer a lot of your queries because it's impossible to cover all these questions in the current meeting, in the current webinar. But yes, I think in the nutshell, thank you all for joining today. It was a very great session. Have a lovely weekend, guys. Thank you all.
Thanks. Bye.